Here we are again. So next video for the third unit of our Research on Corporate Transparency course. Now we're talking about optimal reporting standards. So given that we discussed in the last video the rationales for regulation, and we reached the conclusion that it's not obvious that financial accounting should be regulated or corporate transparency widely defined, but that there are good arguments for why a regulation might make sense in many cases. I think it is a relatively straightforward question to ask now. If we need to regulate financial reporting, we need to come up with the correct way on how to design these reporting standards. So, and this is this notion of normative accounting research. So the challenge is to come up with rules and regulations that firms need to apply in order to report their earnings or their asset values and so on. And for this, we need some guidance, right? So the political sphere, of course, could come up with rules on their own, but we know that in the political process, it's relatively hard to develop rules for such specialized areas. So it would be good if we, as researchers, could guide, the regulators in that regard. So, and of course, the first question to ask is, well, can theory help us here, right? Can theory tell us how to design optimal accounting standards? And like always, I have a quick and blunt answer for you. No. Sorry. No, they can't, but to be fair, using theory, we can have a much more informed discussion. Okay, so, and the reminder of this video is actually my, the task to show you these 2 points. So why is it that theory cannot solve the problem for us? Yeah, why cannot theory come up with the optimal accounting standards? And B, why, given that this is the case, it can still lead to a much more informed discussion. So let's start with the no part, okay? So what is the problem here? There are various ways on how one can explain the impossibility of normative accounting standards. But I want to start with something that many of you maybe know from other studies or from general econ classes, the arrow paradoxon. So the arrow paradoxon is a hallmark of rational choice theory, and it shows a very straightforward thing. It shows that as soon as you move into a multiple person decision framework, and these multiple persons have varying rankings for alternatives, then it becomes, you often run into a situation where it's not possible to clearly rank these options according to the preference of these multiple decision makers. Okay, to explain this problem here in the framework of an accounting problem, I have this stylized example here. So think about you as the regulator. You have the job to come up with the right accounting regulation for asset valuation, and you have 3 alternative ways of what you can do. You can use historical costs, so just stick to the cost at which the assets were originally recognized. You could use lower of cost or market, so an asymmetric costing scheme where you impair the asset if the cost is below the original historical cost, but you don't write up. And you can go to full fair value, so recognizing gains as well as losses in asset value, right? So now let's think about our 3 prototypic stakeholder groups here, and let's come up. So now I come up with some rationales why these stakeholder groups might have different rankings. So an equity investor maybe is really interested in having the true and fair view of the assets clearly stated on the balance sheet, because this allows him or her to come up with relatively efficient pricing signals, and this is why the equity investor prefers the fair value. And if fair value is not feasible, then lower of cost or market, simply because it has at least the downside information available. Historical cost is basically uninformative because it's stale. So this would be the third preference. From the creditor, and we will revisit this issue in a bit when we look into a model. From a creditor, I think there are good arguments to make that lower of cost or market is a very attractive measurement mechanism for creditors, because it signals substantial risks that a creditor cares about, but less so potential gains that a creditor by definition doesn't care that much about, because it's the cake that the creditor does not get, right? So if the firm is doing well, then the creditor doesn't really have a lot from the upside potential. And this is why low of cost or market it is. Well, historical cost is maybe better than fair value for a creditor, simply because fair value might give rise to debt equity agency conflicts. So if the equity shareholders now want the money, so they want their slice of the cake is getting bigger, then maybe they take a little bit too much of the cake and the creditor is left with the crumbles. So this is why fair value maybe is not the preferred method for a creditor. Now you have the manager. Here I think about the manager also, the person that actually has to carry the cost of producing all this information. And maybe let's assume that historical cost is just the cheapest thing to do, yeah, and the manager would like to get away cheap. So this is why historical cost first, and then fair value might be easier because of you don't have to actually compare the cost with historical cost with fair value. Well, this is a little bit of a made-up argument, but lower of cost or market is preferred in this case for the manager. So now, if you, and this is just an example, obviously, if you have this ranking, then I think it becomes obvious that there is no clear preference. So actually, each of the three regimes is listed once in each slot. So meaning, as a regulator, you have now to make a you have to make a political decision. You have to decide whether you take preference, prefer the views of the equity investor, the creditor, or the manager. But there's no way that you can balance these interests, right? So this alone is I think ample proof that in a multiple stakeholder setting, it becomes really hard or impossible to come up with optimal accounting standards because of this problem, right? So then you can also take this to the single person decision-making problem. And there is a very nice paper by Joe Dembski in the Accounting Review in 1973, an accounting classic, like I label it here. So it's called The General Impossibility of Normative Accounting Standards. So topic, right? So Dembski uses a slightly different argument. So he focuses on a single person decision problem, but at the same time has the potential of varying information signals arriving, and thinks about a general information system that partitionates all these different state spaces, information signals that arrive over time. Okay, and now what Dembski shows that the only way that you can actually rank these different information systems is in their fineness, meaning that a system is only then better if it is finer than the other, meaning that it basically subsumes the other system. But as soon as you have two information systems that have varying strengths and weaknesses, let's say, so that they are very fine in some part of the information and a little bit more coarse in another part of the information, then you cannot rank them even for a single person if the information that will come, so the state of nature that realizes, is unknown ex ante. Okay, so this is another way of making the same point, basically, that without, let's say, a very specific setting, you cannot come up with a clear-cut statement of what is optimal and what not. And this is fundamental, yeah. So meaning that there is also relatively little that you can do about it, and that leads to this general notion that we cannot calculate, we cannot figure out what the optimal accounting standards are, yeah, in a general way. So the general way thing is important. So in a general way, we cannot do this. So what does this mean? Yeah. So it means that in the end, setting standards is a political task. So you have to balance different stakeholders, you have to balance different settings, different contractual arrangements, and all this is, it requires to take tough political decisions, because you will benefit some users and maybe put other users at a disadvantage, and so this is again redistribution of wealth. Yeah, well, something that politicians have to deal with, but it is not that we as scientists can figure out how to do this precisely. Yeah. So, but what we can do is we can actually try to explain how accounting standards work, and how in very specific and well-defined settings optimal accounting standards rise endogenously given the circumstances of the setting. And this can inform the debate. And I think this is extremely important to see, because from the first part of the video, you could take away, well, yeah, so whatever, right? So we have to mingle through, and we have to come up with some rules. We cannot figure out what are the best ones. And of course, this would be highly unfortunate. No, this is not the case. So what we can do is we can have very informed debates about how accounting rules work and which accounting rules are optimal for which very specific setting. And then, of course, in the end, it's a judgment call. If you have to standardize over multiple settings and have to reach general rules, then you have to balance all these different, let's say, mechanisms that are in play, and you have to come up with a reasonable argument that supports the general rule that you suggest. Okay? So now I want to give you an example for a very nice paper that actually makes such an optimality assessment. That's a paper by Göks and Wagenhofer, published in JAE 2009, right? Robert Göks and Alfred Wagenhofer wrote this paper at a time where there was a very intense debate about biased reporting or conservative reporting from a standard setter side. So conservative accounting, so meaning that in general it takes a higher level of security to report gains than to report losses. So in the old saying, anticipate all losses but anticipate no gains. Yeah. So this asymmetry in reporting has been around for centuries. But it is still not entirely clear why this actually is, yeah. And in the early 2000s, there was a relatively active debate from international standard setters, predominantly the Financial Accounting Standards Board and the International Accounting Standards Board, about whether this is actually a good thing. And they were favoring neutrality of the reporting regime over conservatism. So the idea of the regulator, of the standard setter back then was, well, maybe it's better to have true and fair view reporting that is unbiased in the sense of neutral, so non-conservative, because this supposedly sends clearer signals to the markets. Okay, so there was a lot of debate around this. And here, I think the paper by Robert and Alfred is really, really, really insightful, because it shows us a mechanism of why this conservative accounting regimes can actually rise endogenously in a theory world where a firm interacts with a lending market. So, and this is, I think, really, really fascinating to see. And it's also what I really like about the paper is that the basic intuition is actually relatively simple once you get it, right? And this is why I picked this paper as an example to show you how a well-developed theoretical argument can actually make a very strong point that also factors into political standard setting. Okay, because back then, there was a lot of debate about this, but then over time, the standard setters actually started to understand better and better why conservatism is actually not a bias thing, bad thing per se. Bias always sounds bad, right? But it might actually be a relatively efficient contractual trick to make markets work more efficiently. Okay, so let's look at this. So what does this paper do? So it is structuring a game like you see here on this sequence of events. So this is directly from the paper, more or less. So you see a firm, and this firm has assets, and we will be focusing on these assets, right? So the firm has assets, and then there is an opportunity for a new investment, right? But for this, the firm actually needs additional capital, and this additional capital the firm wants to raise from a competitive capital market. Okay, so now we're talking about debt capital, right? So we have an owner manager at one side, we have a debt capital market on the other side. The owner manager is risk neutral. The debt capital market has rational expectations, is also risk neutral. So very bare bones, also two-state model to a large extent. The setup is very clean, very simple. So now the accounting system is being designed by the firm, and what the accounting system does, it reports information about the value of the asset. So not about the new the new investment per se, but of the value of the assets. So why is the value of the assets important? Because the firm has to pledge the assets in order to get financing. Okay, so without pledging, only in very rare cases the firm can actually get financing. So meaning that if the investment is in terms of profitability a little bit borderline, then the firm has to seek additional financing by pledging its assets. So now the firm approaches the lender and proposes a contract, and this contract entails the payments, obviously, for the loan and the pledged assets and the reporting regime. So now the firm invests into the project if the contract is agreed upon, simply because only then the firm actually has the resources to invest, okay, and then the payoff of the project realizes. So there is also something that is not obvious to see here, maybe from this sequence of events. There's also an incentive problem here, simply because the owner-manager has to exert effort, and only if the owner-manager exerts effort, then the investment will actually pay off. So there's also so when deciding on whether to give the loan or not, the creditor also has to keep this in mind, so that the incentive structure has to be fulfilled. And I don't want to focus on all this. I just want to give you the guts intuition of why, in such a setting, an asymmetric accounting rule will rise endogenously. So meaning from the specifics of this model setting, and it will be optimal, yeah, so that this reporting regime is asymmetric and conservative. Okay, so now to show you this, I can just reuse some of the stuff that I used in prior videos, because I'm lazy. I can use the visualization format that we also used for unraveling. But it is a little bit different here, so you have to pay attention. I'm sorry, it's not just repetition. So what do we have here? So we have the asset value information that the firm has on the x-axis, and we have the expected value that the lending market sees on the y-axis. And we are talking about the assets here that will be pledged as collateral. Okay, so now behind all this, there is the remainder of the model, which you don't see, right? If the lending market will invest into the investment will be carried out, and also the incentive constraint of the owner manager will be met, meaning that the owner manager will actually apply herself or himself and work hard, and that means that in the end, in the equilibrium, the investment is not necessarily profitable, but it is expected to be profitable on average. Okay, so now there is an important hurdle here, and this is this A hat. A stands for assets. So the value of assets that these old assets, so the pledged assets, need to have, so that the lender is actually willing to lend money. So it's important to understand here that from the perspective of the owner-manager, but also from the perspective of the economy as a whole, you want to invest, you want to finance as many investments as possible. Okay, so to finance more investments is good here, because the investments will only be carried out by the owner-manager if they are profitable in expectation. So it's always good and welfare enhancing if these investments are being carried out. But they can stop from being carried out if the lender, because of the information asymmetry problem here, decides not to lend to the firm, and this will the lender, so the lending market, do whenever the expected value of the assets, so of the collateral, is below this asset value hurdle alpha hat, so not alpha, A hat. Okay, so this is the setup here. So now we start with a very low asset hurdle. So the asset hurdle is very low, yeah. So maybe because the second use value of the assets is very high, or maybe because the likelihood of the assets actually being used is extremely low because the investment is so profitable. But yeah, so it's a new investment, but A hat is very low. So now if A hat is very low, so the optimal accounting regime is actually completely intransparent, right? No firm would disclose. And why not? It's simply to see, because the range of firms that we have here, you know, if they don't disclose, they will be priced based on rational expectations, on the average value of the asset. And the average value of the asset here is clearly above the investment hurdle. So meaning that, you know, nobody discloses. Regardless, the market, the lending market says, well, on average, on expectation, you are all good, right? So I will invest in all these firms, and all the investments will be carried out. Okay, so wonderful. No need to do something fancy in terms of accounting here. Now let's increase the asset value hurdle a little bit. Okay, we do this step by step. So we move it up. Obviously, nothing will happen. But now, so now something will happen, because if we move it higher, then all these nice investments would actually not be financed anymore, right? So now if you move it higher, what happens now is, and this is the I find this very nice. This is the intuition of the Goerks and Wagenhofer paper. Now what happens is I move the asset value hurdle up. Now, the best reporting regime for such a setting is that the poorest firm here, so the firm that has the largest, received the weakest signal on their old assets, that actually discloses an impairment. Okay, so the very weakest, the poorest, so they disclose an impairment. Exactly opposite, if you want, to the unraveling principle, because here now we have a different regime going on. So they report, and so now this now triggers that if this is the disclosure regime here, so that the very poorest have to report. It's important that this is not about voluntary disclosure, so don't confuse this with unraveling here. This is also, you don't necessarily have to think about these being different firms. So this is, you know, these are firms, this is ex ante. So these are firms thinking about potential information that they will get on their assets, and they develop an accounting regime. And the accounting regime that they now have developed is, we will report if we see that we have really, really poor asset value. Then we will report. And this is, we will commit to this, and this becomes mandatory, right? This becomes a rule that is being enforced. And now, if this rule is being enforced and it works out, then this creates an expectation of the lending market, so that all the other firms, so besides the very poor state firm, right, all the other firms, or the other states, I should say, you know, are still on average good enough, so that all these states will actually get financing by the lending market. Okay, so now I think you get the idea. I can now move A hat further up, and you see what will happen is, you know, like opposite unraveling, basically. You see that now more firms will have to impair, so that the remaining firms, the firms that don't disclose, so that still have, let's say, the old historical cost asset value in their book, and these firms have impaired, these firms still have the old asset values in the book. They are pooled to be of, in average, sufficient value to actually get financing, right? So now, the tougher the financing gets, the more firms have to impair, until, you know, here, if you have an asset, you know, if you really need actually to have perfect assets in order to get, you know, for the collateral to be valuable enough, then, you know, everybody has to impair, and you can argue that this then is more akin to something that is close to a fair value regime, right? So then you would have, but this would be a rather extreme situation, right? It would be rather extreme in a sense that only the very, very best firms actually have assets that are good enough so that they can serve as collateral, or that they can be pledged. Okay, very extreme situation of the world. So again, what you see here is that in a relatively simple setup, where you have a competitive lending market, you see that here this conservatism arises endogenously from the contractual arrangement, right? So firms would ex ante design such a reporting regime, and the lending market would like it, right? So it's not, you don't have to think about this has been something where the owner-manager screws over the lending market by pooling firms that are actually not above the hurdle. No, you have to think about the lending market as a risk-sharing institution in the economy that is interested to share, to finance firms. And it's not important that the lending market breaks even on every single loan. No, it is important that the lending market breaks even on average. So it's risk sharing here, right? And you can have risk sharing, and because of that, more investment, if you allow firms to be pooled. If you force firms to be completely transparent in your regime here by providing fair value on everybody, this will reduce the number of firms that get loans in this setup here. And this is important to understand, right? So you always think about transparency is a good thing. Yeah. Here you have a situation where this very notion, in situations like this, where you have a large pooling part of the market which is not transparent, is exactly the reason why the lending market is capable of doing its job here, financing multiple investments. And remember that all these investments are good investments from the perspective of the owner-manager, right? They are good. It's only that, you know, there is a certain likelihood that they will fail, yeah, and this certain likelihood that they will fail is being here carried by the lending market as well. Risk sharing, right? Endogenous conservative accounting facilitates risk sharing in the economy. A very important insight, I think, based on theory, and very relevant also to standard setters. Yeah, because it helps standard setters to understand why sometimes biased, you know, in terms of conservative accounting, can actually help risk sharing in the economy across the lending market, and by this actually foster investment in economic growth. Things are not always obvious, and so theories like this can actually help a lot to inform the political debate. And that was the point I was trying to make in the beginning, right? So theory cannot settle the issue for us once and for all, but it can help us to think clearer about it. Isn't that nice? Okay, perfect. This is it for the question of regulation. Now we move on and think about incentives and earnings management that result from regulatory reporting rules. Okay, thanks. Cheers.